The AI bubble just burst and it's 17 times larger than the dot-com crash, 4 times bigger than the 2008 housing collapse. While tech stocks crater and trillion-dollar valuations evaporate overnight, Wall Street keeps insisting the real economy is fine. They're wrong. The shockwave hasn't hit housing yet, but it's coming. Fast, brutal, and unavoidable. Nvidia down 8% this month despite record revenue. The S&P 500 bleeding for 4 straight days. Bitcoin crashing below $90,000, wiping out every gain from 2025. Alphabet's CEO admitting parts of the AI boom involve irrationality. Tech companies are burning $400 billion per year on AI infrastructure that isn't generating returns. Venture capital funding has collapsed 68% year over year, and the layoffs are accelerating. Here's what nobody's connecting. The same cities that rode the AI boom to record home prices, the markets where $5 million homes are selling 82% faster than last year, where rents jumped 6% in a single year, where luxury condos trade like Bitcoin at peak hype, those markets are built on money that just evaporated. When AI engineers lose their $300,000 salaries, when startups shut down and stock options become worthless, when venture capitalists stop writing checks and tech campuses go dark, housing doesn't just soften, it collapses. The stock crash happened this week. The housing crash is next. And these 7 cities, from Silicon Valley to unexpected bubble markets across America, are sitting on the most dangerous real estate time bombs in the country. The dominoes are falling. These are the markets that will be destroyed first when the AI dream becomes a foreclosure nightmare. Number 7. Austin, Texas. Austin bet everything on becoming the next Silicon Valley, and that bet is about to blow up. The city's median home price sits at $565,000, nearly double what it was 5 years ago, fueled by a tech migration wave that's now reversing. Tesla's headquarters, Oracle's campus, and hundreds of AI startups promised Austin would be the future. That future just collapsed. Tech layoffs have already started accelerating. Major companies that expanded aggressively during the pandemic are now cutting deep. Google, Amazon, and dozens of startups have eliminated thousands of positions in the Austin metro. And this is just the beginning. The housing market is already showing cracks. Inventory has surged while days on market have climbed from 30 to over 60 days. Homes that once sparked bidding wars now sit with price reductions. But the real disaster is coming. Austin's entire economic model depends on high-earning tech workers paying premium prices for homes. The median household income in Austin is $91,000. To afford the median home at current rates, you need to earn $160,000. That $69,000 gap was filled by stock options, sign-on bonuses, and the belief that AI jobs were infinite and secure. When those jobs vanish and that wealth evaporates, the gap doesn't close. It widens into foreclosures. Commercial real estate tells the future story. Office vacancy has already hit 22%, and sublease space is flooding the market as companies abandon commitments. Downtown Austin, once impossible to navigate due to construction cranes, now has half-finished towers and for-lease signs multiplying. When the AI money stops flowing, Austin won't correct gradually. It will crater fast and hard. Number 6. Boston, Massachusetts. Boston styled itself as the intellectual capital of artificial intelligence, home to MIT and Harvard's AI labs, surrounded by hundreds of machine learning startups and research firms. That concentration is now its greatest vulnerability. The city became a magnet for AI venture capital, with billions pouring into robotics, autonomous systems, and deep learning companies clustered around Cambridge and the Innovation District. Salaries exploded and housing prices followed. The median home price in Greater Boston hit $715,000, while Cambridge crossed $1.1 million. Those valuations depend entirely on AI money continuing to flow. It just stopped. Venture capital investment in Boston area AI companies has cratered. Funding that reached nearly $9 billion in 2023 has collapsed as investors realize most AI startups will never generate revenue. Companies that raised at billion-dollar valuations are quietly shutting down or slashing staff by 50% or more. The job losses are already beginning, and they're about to accelerate dramatically. When AI researchers earning $250,000 per year lose their positions, when stock options in failed startups become worthless, When the ecosystem of cafes, services, and landlords built around tech wealth starts collapsing, housing will follow immediately. The luxury condo market shows where this is headed. New developments in the seaport built explicitly for tech elites are seeing longer days on market and quiet price negotiations. Inventory is climbing while buyer traffic drops. Boston's municipal budget depends heavily on property tax revenue from these inflated valuations. When home prices reset downward by 20 or 30%, the city faces budget crises that will compound the economic pain. Boston built its future on artificial intelligence. That future is artificial. The collapse is real. Number 5. Los Angeles, California. Los Angeles carries a double risk that most people aren't seeing. It's not just exposed to the AI crash through tech wealth, it's already sitting on elevated bubble risk that economists have been warning about for months. The median home price in LA County is $912,000, requiring an annual income of $260,000 just to qualify for a mortgage. The actual median household income? Just $76,000. That catastrophic gap has been sustained by entertainment industry money, tech spillover from Silicon Valley, and speculative investment. All three pillars are cracking simultaneously. The AI crash hits LA harder than people realize. Thousands of tech workers and AI professionals who couldn't afford San Francisco moved to LA, driving up prices in Silver Lake, Culver City, and Venice. Streaming platforms and entertainment companies poured billions into AI-driven content creation and recommendation algorithms. Those investments are being slashed. Netflix, Disney, and Amazon have already announced major cuts. The spillover effect means production crews, writers, and service workers all lose income at once. Commercial real estate is collapsing faster than residential. Office vacancy in downtown LA has climbed past 24%, and iconic buildings are trading at 40% discounts to their 2021 valuations. The city's budget is straining under pension obligations and falling tax revenues. When the AI wealth effect reverses, when tech money stops flowing into LA's housing market, and when entertainment companies finish their restructuring, prices won't correct gradually. The math doesn't allow it. Homes will have to fall 30 to 40% just to approach affordability. And in a market this over-leveraged, that kind of correction doesn't happen smoothly. It happens in waves of foreclosures and forced sales. Number 4, Miami, Florida. Miami has the highest housing bubble risk of any major market in the world, not just in America, globally. And the AI crash is about to pop it. This might seem unexpected for a city without major tech headquarters, but Miami's housing boom was fueled by wealth migration from exactly the people about to lose everything. Tech executives, crypto millionaires, and AI entrepreneurs fled California and New York, bringing inflated West Coast money to Florida's tax-free paradise. They bought $5 million penthouses in Brickell, beachfront estates in Miami Beach, and luxury condos in Sunny Isles, all with cash or financing backed by stock portfolios. Those portfolios just lost 30 to 40% of their value. The median home price in Miami hit $625,000, but the real action was in luxury. Sales above $10 million doubled in 2 years as newly minted AI millionaires competed for trophy properties. That demand is evaporating right now. When tech wealth disappears, Miami has no backup economy strong enough to support these valuations. Tourism and hospitality can't fill the gap. The city's median household income is just $57,000. The locals were never buying these homes. It was all outside money, speculation, and leverage. Insurance costs compound the disaster. Hurricane risk has already pushed premiums up 45% since 2022, and major insurers have pulled out of Florida entirely. Condo fees are skyrocketing. Foreign investment is slowing. The perfect storm is forming. Miami's bubble was inflated by exactly the wealth that the AI crash just destroyed. When those buyers disappear, when forced sales begin, and when reality meets fantasy pricing, Miami won't correct. It will implode. Number 3, Seattle, Washington. Seattle's economy runs on two giants, Amazon and Microsoft, and both are at the center of the AI collapse. Microsoft has poured tens of billions into OpenAI and AI infrastructure across its entire product line. Amazon bet its future on AI-driven logistics, cloud services, and Alexa's evolution. These weren't side bets, they were core strategy, and they're not paying off. Both companies have already announced massive layoffs in 2024, cutting over 30,000 positions combined in the Seattle metro. The AI investments that justified those hiring sprees are now being written down or abandoned entirely. More cuts are coming. Seattle's median home price sits at $827,000, propped up entirely by tech salaries that average over $180,000. Take away those salaries, and the math collapses instantly. Housing inventory has already surged 52% year over year, while sales have dropped nearly 20%. Homes in Bellevue and Redmond, ground zero for Microsoft and tech workers, are sitting longer and seeing price cuts of 10 to 15%. The luxury rental market is in free fall. Apartments built for high-earning tech employees are offering massive concessions, 3 months free rent, $5,000 move-in credits, and still hitting 40% vacancy rates. Seattle's dependency on tech wealth is absolute. Nearly 40% of the city's tax revenue comes from high earners in the technology sector. When those jobs vanish, the budget collapses, services get cut, and the downward spiral accelerates. Commercial real estate vacancy has already exceeded 28% downtown. Seattle isn't diversified, it's trapped. And when the AI money stops, everything built on top of it comes down. Number 2, San Francisco, California. San Francisco is ground zero for the AI bubble, and the collapse will be biblical. This is the city where OpenAI, Anthropic, and hundreds of other AI startups raised billions on promises they can't keep. Where venture capitalists wrote $50 million checks based on PowerPoint slides. Where software engineers commanded $400,000 salaries to build products that generate almost no revenue. That entire ecosystem just imploded. The median home price sits at $1.3 million, but luxury sales tell the real story. Homes above $5 million have been selling 82% faster than last year, driven by AI wealth that literally evaporated this week. Those buyers are gone. San Francisco has already lost over 65,000 residents since 2020, and the exodus is accelerating. Tech layoffs in the city proper exceeded 28,000 in 2024 alone. Salesforce cut 10,000 positions. Meta eliminated thousands more. Startups that burned through hundreds of millions are shutting down without ever launching products. The commercial real estate disaster shows the future. Office vacancy stands at 23%, the highest of any major U.S. city. Rents have crashed 32% since the pandemic, and major landlords are defaulting on loans. But here's the insanity. While all this happens, residential real estate agents are still celebrating because the data lags reality by 6 months. San Francisco's budget deficit for 2026 is projected at over $1 billion as tax revenues collapse. The city that defined the AI revolution is about to be destroyed by its collapse. When reality catches up to housing prices, the correction won't be 10 or 15%, it will be 40% or more. Number 1, San Jose and Silicon Valley. This is the epicenter, the absolute ground zero of the AI bubble and the housing catastrophe waiting to happen. San Jose's median home price is $1.4 million. Palo Alto averages over $3 million. These aren't just the most expensive housing markets in America. They're the most exposed to an industry that's collapsing in real time. Nvidia's headquarters sits here, Google's AI division, Apple, Meta, hundreds of startups burning cash they no longer have. The wealth that built these valuations is vanishing. The irony is devastating. Silicon Valley housing just hit record highs while the industry supporting it crashes. That's not strength, that's lag. It's the market celebrating at the peak before realizing the ground disappeared months ago. When the full weight of AI layoffs hits, when stock options become worthless and venture funding stays frozen, these markets won't correct. They'll collapse spectacularly. The AI bubble burst. The housing crash is next, and these 7 cities will fall first and hardest.